At 4:47 a.m. on March 2, 2026, the global energy order effectively fractured. An Iranian drone strike on the Ras Laffan industrial city gas complex in Qatar did not just damage a piece of infrastructure, it silenced the world's largest liquefied natural gas export facility. In 2025, Ras Laffan shipped approximately 81 million metric tons of LNG, accounting for roughly 20% of the global seaborne gas market. Crucially, every one of those cargoes is forced to transit the Strait of Hormuz, with no overland alternatives and current Qatari estimates projecting a 3 to 5 year timeline for repairs. The strategic reality for Europe shifted overnight. The immediate fallout was visible in the logistics of energy supply. Less than 2 weeks after the strikes, the Malacca Max, a Qatari-flagged LNG carrier bound for the Dunkirk regasification terminal in France, was forced to divert to storage off the coast of Singapore. That cancellation triggered a force majeure notice for a single French utility, but it was a harbinger of a broader systemic failure. By April, data indicated that roughly 37 Qatari carriers and their vital cargoes had effectively vanished from the European supply calendar. For Germany, the impact was immediate and quantifiable. On April 3rd, the government slashed its 2026 economic growth forecast from 1.3% to 0.6%, effectively wiping out more than half of its projected growth in a single adjustment. Economy Minister Katharina Reichel summarized the precarious state of the nation in a recent Financial Times interview. "We need gas to secure our supply. That is the only baseload supply I have left. Politically speaking, I have no alternative." That detail tells you the true depth of the crisis. Without its retired nuclear fleet, its winding down coal operations, and relying on intermittent renewables, Germany is structurally tethered to natural gas. The result is a widening chasm in energy security. Futures contracts for German electricity delivery in May are currently trading at 4 times the cost of equivalent French contracts. As BASF and ThyssenKrupp announce production curtailments due to these unsustainable energy cost differentials, the industrial anchors of the German economy are being forced to scale back. This is not just a localized shock. European gas storage levels, which were already suffering from a cold 2025 winter, sat at 30% capacity in early March, far below the 10-year average of 54%. As Europe scrambles to replace 9 million tons of annual Qatari supply, the continent is being forced into a rapid, high-stakes realignment that will define its industrial future for a generation. To understand the scramble for Atlantic Canadian gas, we have to look past the frantic press releases and examine the structural reality of the European industrial collapse. As we established, the Ras Laffan strikes didn't just cause a price spike, they shattered a central assumption of the European energy transition, that global LNG markets would remain a fungible, fluid, and predictable sea of supply. That detail tells you why the tone in Brussels and Berlin shifted so abruptly from green transition rhetoric to strategic resource survivalism in under 48 hours. The economic data behind this pivot is stark. On April 16, 2026, the German Federal Ministry for Economic Affairs and Energy, BMWE, confirmed that it had secured EU state aid approval for a €3.8 billion industrial electricity subsidy. This isn't just a handout, it is an admission of failure. By subsidizing electricity prices to prevent the total exodus of chemical and steel giants like BASF and ThyssenKrupp, the German state is essentially trying to patch a structural wound with a fiscal band-aid. The reality is that these subsidies can only offset half of a company's electricity consumption and are capped at a reference price of 5 cents per kilowatt hour. For an industry that requires consistent, high-heat energy as both a fuel and a raw chemical feedstock, this subsidy is a defensive stall tactic, not a long-term solution. Taylor Wessing here is what that means. Germany's industrial sector is currently locked in a race against its own obsolescence. The German Energy Association BDEW reported that energy-intensive sectors have been hovering at 80–85% of pre-2022 production levels for 2 years. The Qatar disruption, by driving prices to a 4 times premium over French nuclear-backed electricity, has pushed those companies into the curtailment zone. When you see a company like BASF announce second-quarter production cuts, you aren't seeing a temporary maintenance break, you are seeing the start of a permanent structural shift. Clean energy wire enter Canada. On May 14, 2026, Prime Minister Mark Carney unveiled the National Electricity Strategy, a $1 trillion effort to double grid capacity by 2050. While the headline focuses on domestic green grid expansion, the strategic undercurrent is a deliberate alignment with European demand. The strategy explicitly acknowledges a strategic role for natural gas in complementing intermittent wind and solar, a phrasing that provides the necessary regulatory cover for the Canadian government to fast-track Atlantic LNG infrastructure. Morningstar's show one Total Energies, the French oil major, is the entity that is connecting these dots. Total has been in advanced talks with Canadian counterparts throughout the spring of 2026, moving beyond simple off-take agreements into the realm of upstream equity. By underwriting the development risk for projects like Goldboro and Bearhead, the French are doing what the Germans cannot. They are locking in the physical supply chain at the source, as a senior EU official noted in an Ottawa dispatch on March 3rd, the day after the strikes. There was initially little appetite for large-scale Canadian fossil fuel imports, citing the 2015 Paris Agreement targets. But listen to how that rhetoric has evolved. By mid-May, the conversation in Brussels shifted from decarbonization to energy security and competitiveness, as emphasized by the Letta and Draghi reports on EU market integration. The shift is not about the EU abandoning its green goals. It's about acknowledging that a decarbonized industry is impossible if the industry itself vanishes entirely from the continent. Canadian Renewable Energy Association, you show one. The strategy is now clear. Europe is attempting to bypass the volatile, war-prone choke points of the Suez and the Strait of Hormuz by building a North Atlantic energy bridge. This is why the delegation to Ottawa was so heavily focused on the Nova Scotia coast rather than the Pacific terminals. The Atlantic route is effectively a protected supply line, immune to the Houthi-style disruptions that paralyzed the Red Sea. Yet, for all this strategic maneuvering, a massive, unresolved variable remains. While Germany and France are desperate for this Canadian supply, the Canadian internal political machine is struggling to reconcile this rapid export expansion with its own ambitious, trillion-dollar domestic green grid build-out. Can Canada actually build the infrastructure fast enough to satisfy the German appetite? Or will the domestic requirement to double the grid end up cannibalizing the very resources needed to ship LNG to Europe? The next 60 days will decide the fate of these projects, and consequently, the survival of the industrial heart of the European Union. The situation we have dissected over the last few weeks is not merely a regional energy crunch. It is the definitive end of the efficiency-first era of global commerce. As we move into the summer of 2026, the cascading effects of the Ras-Laffan strikes have forced a brutal realization upon the European leadership. In a world where key maritime choke points like the Strait of Hormuz can be closed by a few hundred kilograms of explosives, supply chain reliability is no longer an economic luxury. It is the prerequisite for sovereign existence. The scramble for Canadian Atlantic LNG is not a choice made out of preference for the North American market, but a desperate, forced migration toward the only geography that offers a secure, unchoke point-free path to Europe. For the key actors involved, the implications are becoming irreversible. For Europe, the Transatlantic energy bridge represents the abandonment of the hope that market-based diversification could replace physical security. By shifting toward long-term off-take contracts with the continentals in Nova Scotia, Brussels and Berlin are effectively choosing to pay a permanent premium for security of supply in exchange for independence from the volatility of the Gulf. This is an admission that the European industrial model, specifically the chemical and steel giants that form the backbone of the German economy, cannot compete on global markets if its core inputs remain subject to the whims of regional conflicts at sea. Anno control or deter for Canada. This represents a sudden and monumental shift in its geopolitical weight. The federal government's move to accelerate the Goldboro and Bearhead projects is transforming Canada from a hesitant, internal-facing energy producer into the security buffer for the Western industrial world. The National Electricity Strategy, as well framed as a domestic green transition, is the infrastructure platform that will allow Canada to play this role, but it brings a new internal tension. The demand to supply Europe will increasingly compete with the domestic requirement to decarbonize and expand the grid. Canada is no longer just a resource exporter. It is becoming a critical strategic asset in the new fragmented global economy. For the United States, the implications are more subtle but equally profound. While the U.S. remains the largest exporter of LNG to Europe, the concentration risk perceived by European capitals, born from years of tariff disputes and erratic diplomatic signaling, has created a hard limit on how much the EU is willing to rely on American energy. The pivot to Canada is, at its heart, a signal that Europe will accept higher costs to secure allied diversity, effectively creating a two-tier system for energy procurement that favors political reliability over pure price optimization. What we are witnessing is the permanent segmented ion of energy markets. The era of the global price for LNG, anchored by the seamless transit of Qatari and Middle Eastern gas through the Suez and Hormuz, is dead. In its place, we are seeing the rise of regionalized, secure, and politically aligned energy blocks. The most important takeaway is this: the structural deficit created at Ras Laffan cannot be fixed by repairs alone. Even when the turbines are eventually replaced and the export trains return to service, the geopolitical risk premium will remain permanently baked into the cost of Gulf energy. The world is moving away from the efficient, fragile, and globalized energy system of the last 30 years and into a new, more expensive, and more rigid order defined by geography, security, and necessity. Riviera Maritime Media. Issue 1. The tankers are already in motion. The contracts are being signed in the shadows of boardrooms from Halifax to Hamburg, and the industrial map is being redrawn. We are not watching a temporary correction. We are watching the permanent decoupling of the Atlantic from the Middle East. The transition is complete, and the new reality is one where Curicor D is the only currency that matters.